Hello friends, this is our 11th video lecture and it will be about IAS 2 inventory. So, scope of IAS 2 inventory. IAS 2 applies to raw materials, work in progress, finished goods, goods acquired for resale. Definition of inventory. Inventories include assets held for sale in the ordinary course of business, that's finished goods or goods held for sale. Assets in the process of production for such sale, that's work in progress. Assets in the form of materials or supplies which are going to be consumed in the production process or in the rendering of services. Scope of IAS 2. Items which are not in the scope of IAS 2 are financial instruments, work in progress arising under construction contracts, biological assets related to agricultural activity and agricultural produce at the point of harvest, inventories held by producers of agricultural and forest products, agricultural produce after harvest, mineral products and minerals which are measured at net realizable value in accordance with established industry practice, and inventories held by commodity traders who measure their inventory at fair value less cost to sell. Initial recognition. Items of inventory should be measured at the lower of cost and net realizable value. Initial recognition of inventory is at cost, which includes the purchase price of inventory item. However, if there are any discounts and rebates, they must be excluded. So purchase price must be adjusted. Transfer costs must be included. Import duties and other non-recoverable taxes could be included too. Other costs directly attributable to the inventories, for example, direct material and labor costs, variable production overheads, for example, indirect material and labor costs, and fixed production overheads, for example, depreciation and maintenance expenses, could be included too. Costs which are not allowed to be included in the measurement of inventory cost are abnormal amounts of wasted materials or labor. Storage costs. However, in this case, in case of storage costs, there is an exemption. Storage costs can be included if these costs are a necessary part of the production process. Administrative overheads are not allowed for inclusion, because such costs do not contribute to bringing inventories to appropriate condition and location. Selling costs are excluded. Borrowing costs, there is an exemption in this case too, as you probably remember, in accordance with IAS 23, where production lasts long period of time and production volumes are small, the cost of inventories could include borrowing costs. However, that's an exemption. Borrowing costs are usually excluded. So, let's discuss interchangeable and not interchangeable items. Not interchangeable or heterogeneous items, that's diverse in character or content items. So you cannot substitute one item by another in case of not interchangeable items. Interchangeable items or homogeneous items are of the same kind or alike. So you can substitute one item by another in case of interchangeable items. If inventory items are heterogeneous, the cost of such items should be established individually for each item. If inventory items are homogeneous, it is necessary to apply one of next cost formulas: FIFO, first in first out, or weighted average cost. There is another method called LIFO, last in first out. According to LIFO, it is assumed that newest items of inventory are sold first. That is why last in first out. This method is not allowed according to IFRS. According to IAS 2, the same cost formula should be used for all inventories of a similar nature. Therefore, it is possible to apply the two methods simultaneously to items with different nature and use. According to FIFO, it is assumed that the oldest inventory items are used first in the production process. That is why first in, first out. Weighted average cost method computes an average unit cost of the items on hand. So actually you take total cost of inventory items and divide these costs by number of inventory items in order to receive weighted average cost. So let's look through a simple example. Fluffy Kitten, our entity, paid $5 per unit for the raw materials, and direct labor costs are $4 per unit. So production overheads was $120,000 based on normal output of 12,000 units. During the year, only 10,000 units were produced and 2,000 units were in inventory at the end of the year. Some part of units were not stored properly and were damaged. It was estimated that 400 damaged units could be sold for $20 per unit after repairs of $3 per unit. So we need to define amount of closing inventory that would be shown in statement of financial position. So let's try to solve this task, and step 1, our step 1 will be to calculate direct costs. In order to calculate the direct costs, we need to take $5 per unit purchase price and also direct labor costs in the amount of $4 per unit. So we take our purchase price of $5 plus our direct labor costs, which gives us $9 per unit. Step 2, we need to calculate overheads based on normal output. So we have our total overheads of $120,000. We have our normal output of $12,000, and we have our overheads based on normal output of $10 per unit. We need to take normal output, not an actual in this case. So that's why we take 12,000 units of normal output. And we have our total costs per unit in the amount of $19 per unit. That how did we get $19? That's actually our direct costs plus our overheads based on normal output. So 9 plus 10 gives us $19 per unit. So let's calculate net realizable value of damaged items. We can calculate it just if we take our price of $20 per unit and subtract $3 per unit repair costs. So if 20 minus 3, it gives us $17 per unit. So NRV of damaged items is $17 per unit. And then step 5, we need to calculate NRV for undamaged items. So we have only price here of $20, so let's assume that $20 is also a price for undamaged items too. In case of undamaged items, we don't have to repair them, they are ready for sale. So, and we don't have any information about any selling costs, so let's assume that $20 is the price of undamaged items too. So in this case, NRV of undamaged items will be $20 per unit. And step 6, cost of damaged units. We take the quantity of damaged units and multiply it by the lower of net realizable value and cost. The lower here is $17. Net realizable value of damaged items $17 per unit. Total costs per unit are $19. So in this case, NRV, net realizable value, is less than cost of $19. That's why we multiply here by 17, and this gives us the cost of damaged units in the amount of $6,800. Then we can calculate cost of undamaged units. So we take our cost of undamaged units, 1,600. Why 1,600? Because we have 2,000 units in inventory at the end of the period, at the end of the year, and we have 400 damaged units. So 2,000 minus 400, that is why the quantity of undamaged units is 1,600, and multiply it by lower of cost and net realizable value. In this case, net realizable value $20 and cost is $19. So in this case the cost is lower, so we take cost, and this gives us the amount of $30,400. And then the last step, we can calculate the amount of closing inventory in balance sheet. So we take 6,800 plus 30,400, and this gives us $37,200. So that is the end of our lecture number 11. I hope it was useful. Thank you very much for watching. Bye.